and welcome to the November webinar. In these sessions, we are going to touch on updates to the FIC, legislation on the horizon, which, if you recall, was going to be our October webinar, but the introduction of the new cell captive arrangements took precedence. And then to finalize the webinar today, Peter will be touching on the conflict of interests, the brief updates that have occurred there. We do apologize about the technical glitch that we experienced this morning, which means that there will be no live Q&As. So please, if you could, any questions could be directed to either Jeanette or to Peter. Their information will be up at the end of the sessions. So we'll immediately jump into the updates to the FIC legislation.
Right, let's have a look what FICA has in store for us. On the 14th of October 2022, amendments to the money laundering and terrorist financing control regulations were published, and these regulations noted the revision of the cash threshold reports and cash threshold report aggregation. In this section or session, we are going to have a look at exactly what these revisions entail. Firstly, let's have a look at the cash threshold. That cash threshold limit has increased from 24,999 to 49,999 Rand and 99 cents. The cash threshold transactions will no longer need to be reported within the 2 working days, but rather 3 working days after becoming aware of the cash transaction or a series of cash transactions that exceed the prescribed limit. I do want to point out that when we say becoming aware of a transaction, it doesn't mean when the cash reporting officer becomes aware of it. It actually means when any employee of the dealership becomes aware of such a transaction or series of transactions. In addition, the requirement to report cash threshold aggregation will be removed or has been removed. Now, cash threshold aggregation, if you remember rightly, is if you receive a number of hard cash deposits within 2 days or after 2 days, and if you add it together, it exceeds the limit. Now, the reason they've removed that is because if somebody does that, they know what the requirements are, and it can be assumed that they're doing it specifically that way in order not to be reported. So immediately that becomes a suspicious and unusual transaction, and you have to report it accordingly. Now, all of this takes effect on the 14th of November, 2022. What you need to remember is these reports that you've submitted based on the old regulation still needs to be submitted based on the old rules if you've received cash threshold transactions up until the 13th of November. So with effect from the 14th of November, new rules will apply. So if on the 13th of November you receive the cash, you become aware of it, you still have 2 days to report it under the old regulation. Okay, so they will keep the system open for you guys in order to ensure that the reports are done correctly and to also do remediations on reports that might have been previously incorrectly submitted. You know, on the GoML system, if it's rejected, you need to go and have a look and redo that specific report. Now, what you'll see on the screen, it says cash threshold report aggregation. That line will disappear soon. So I sort of suspect it would be in the first week after the 14th of November. But yeah, you never know. It's going to be very soon. So if you have cash threshold reports, aggregation reports that need to be submitted, submit them as quickly as possible. But as I said, from the 14th of November, that will no longer be a requirement. So it will definitely disappear. Another thing that the FIC wants to inform all accountable and reporting institutions of is that they have a Goa AML staging user acceptance testing platform, a UAT, long ass words. Anyway, so if you go to that website, you can register and you can actually test the new reporting pages. So they're not going to change the entire GoAML. They're just going to amend it slightly to accommodate for the new reports. You'll see that on this slide, there's still the 24,999. As I said earlier on, if you've received cash in excess of the old limit, old rules will apply. From the 14th of November, it would be new rules. Then on the next slide, you'll see that they have increased it to 49,999. So please go and have a look at that. When you report, select the correct one. If you've received a threshold, cash threshold transaction or a cash threshold amount on the 14th of November, then this is the reason that you need to select, right? Okay, dokes. Now, and here again, the cash threshold report aggregation will be removed. Good. Now, let's have a look at reporting. Reporting with regards to cash threshold, the Financial Intelligence Center wants more information, and they have listed it in the regulation amendments, and we're quickly going to have a look at what this information is that they require from you guys. Okay. So when you submit a cash threshold report, they need the full particulars of the accountable or reporting institution making the reports. And so they need your full name, and that is relating to the institution. Then they would like to receive the identifying particulars of that institution on whose behalf the report is being made, and that needs to include your company registration number or license number. They need your contact address. They need the type of business or economic sector in which you are playing in. So it all relates to the institution. Just have a look what the next slide says. So if the institution, if it's a legal person or an entity making the report, they need the surname and the first name and the date of birth and the contact particulars of the contact person who may be contacted in relation to this report. So your cash reporting officer, if that person is making the report, they need all that information so that they can contact your cash reporting officer if they have any questions. If the person making the report is a South African citizen or resident, they need identifying particulars of that person, as well as the type of ID document from which the particulars were obtained. And if the person is not a South African citizen or resident, they need the identifying particulars of that person, as well as the source of identifying information from which the particulars were obtained, and the issuing country thereof. Okay, so that would relate quite possibly to passports and permits and those type of things. Right, let's carry on. If we look at the actual transaction, that report must have full information of the location where the transaction took place, the date of the transaction, the value of the transaction in local currency. In other words, if the person paid us in rands, and a description of how the transaction was concluded. The FIC also need as much information as possible concerning the currency in which the funds were disposed. output. In respect of the natural person conducting the transaction, or the legal person or entity on whose behalf the transaction is conducted, for the specific cash threshold report, that report must have the following information about that natural person. So we need that person's title, gender, name and surname, the person's ID number, nationality, as well as date of birth. We need the source of identifying information from which you received the title, gender, name, and surname, as well as ID, nationality, and date of birth. You need that person's contact address in South Africa. You need the person's contact number. You need the person's occupation, country of residence. If the person is not a South African citizen, we would like to know where does he stay, what is his country of residence. If he's got an alias, he needs to put that down. The source of funds is important. That person's income tax number, and of course, his employer's name, contact details, and contact address. So telephone number and address there. Name. So if the person is a legal person, we need this information. The person or the entity's name, so that's the legal person. That entity's identifying number, if it has such a number. We need to know who's the natural person that's got the authority to conduct the transaction on behalf of the person or entity. And in case of a company, all that information, the information on the natural person, this block here, we need all this information on at least one of the directors of the company. If it is any other type of legal person, we also need this information in respect of at least one natural person associated with that legal entity and the role that that person plays in that legal entity. Right. Now, let's just carry on. Reporter involved in the cash threshold reporting transaction. So this is information that we need about that specific reporter. We need the account number. We need, again, the name and identifying particulars of the branch or office of the reporter where each account is held. We would like to know what's the type of account, the currency in which the account is denominated, and the date in which the account was opened. Now, the FIC also needs as much of the following information in respect of each signatory on this specific account. So again, we need that person's title, gender, name, and surname, ID number, nationality, date of birth, source of identification information. In other words, where did you get this information from? If he's got an alias, we would like that, please. The contact address in South Africa. If the person lives in another country, we would like to know the country of residence, as well as the contact details of that individual, which includes his address. We would really like to know where this person works, what's his occupation, what does he do. Source of funds is extremely important, as well as the income tax number. And of course, again, his employer's details, name, address, particulars, and so forth. What you also need to keep in mind is that the cash threshold reports must contain as much as possible information on the indicators or the indicator that gave rise to the submission of that specific report. So these are the changes that takes effect on the 14th of November. I do want to recommend that you update your FIC policy accordingly and inform your staff. Inform your cash threshold, your cash reporting officer. Speak to your DP, speak to your salespeople. Make sure that everybody understands what is required, that they know about the additional information. And let's get cracking. 14th of November deadline. Right. Thank you very much. Hello, everybody. FICA is really a flavor of the month at the moment. We've all been waiting for changes to Schedule 1. It's been on the cards for quite a long time. The Financial Action Task Force has released a mutual evaluation report last year. And if you read it, you'll see South Africa has got a problem. We are possibly going to be grey listed, which will be devastating to our economy. So, if you think about all of this, then it just makes sense that the Financial Intelligence Centre rushed to Parliament and said, please pass these amendments very quickly to our money laundering laws. And these amendments includes adding high-value goods dealers to accountable institutions list, which is Schedule 1. So I just want to have a look at what is the definition of a high-value goods. The definition is nicely noted on the screen. You can see it there, but it basically means if you're a business that's dealing in goods that cost more than 100,000 Rand, then you're going to be accountable institution. So in the motor industry, you would fall in that definition. I'm not aware of a lot of motor dealers that actually sells vehicles that cost less than 100,000 Rand. Now, accountable institutions are required to have an RMCP, which stands for Risk Management Compliance Program. And this document must be designed around a risk assessment that you've conducted, and with specific focus on money laundering, terrorist financing, and proliferation financing. Nice big word. Now, money laundering, as you well know, is the manipulation of money or property in order to disguise its true source, whereas terrorist financing relates to the solicitation, collection, and provision of funds and other assets with the intent to use that funds to support terrorist acts, terrorist organizations, or individual terrorists. Now, proliferation financing, I'm going to explain to you what it is. I'm not 100% sure if it really is going to relate to the motor industry, but we need to know what it is. So proliferation financing relates to an activity which may have an effect on providing property, a financial or other service or economic support to a non-state actor that may be used to finance the manufacturing, acquisition, possessing, development, transport, transfer, or use of nuclear, chemical, or biological weapons in their means of delivery. So, I don't know. This is open for discussion. I'm very keen to hear your comments in this regard. I'm definitely not certain that proliferation financing will have an impact on the motor industry, but we can chat about that. So now that we know what these definitions mean, we need to have a closer look at what will be required from you. Your risk management and compliance program needs to have governance controls, and these governance controls need to show certain things. It firstly needs to show the roles, responsibility, governance structures, and oversight functions of your compliance officer, the compliance function, the board of directors, senior management, and all of that needs to relate to compliance with the FIC Act and your risk management and compliance program. You have to appoint a Section 42A compliance officer. Now, this compliance officer cannot just be anybody. It must be somebody that actually understands what all of this is about, how to apply the FIC Act. They need to have the authority, so it needs to be a senior person within your institution to fulfill this function and to take responsibilities in terms of the FIC Act. They need to have sufficient independence and to have access to all areas of the institution's operations in order to effect corrective actions accordingly. They need to be able to either monitor the compliance with the FIC Act or outsource monitoring of compliance, but they will remain responsible. Just keep that in mind. Okay. Then this money laundering compliance officer is going to be responsible for quite a lot. They will need to make sure that your RMCP is in place, all the processes are being adhered to, that your employees know exactly what's required from them. They need to be able to change the policy and procedure if it is needed. So you can see that this is not just something that you select the closest oak and say, right, okay, you're the compliance, the money laundering compliance officer, and off you go. This needs to be a senior person with PIPs, a guy that's got the authority to change rules, to make rules, to enforce rules, and to take action if there's any non-compliance. Your RMCP must also note that it's been approved by your senior management, which would be your board of directors, or that level of management relevant to the type of organization of your organization. It must state when this document will be reviewed. It needs to specifically say which employees will be responsible for certain functions. So we'll have, for example, your client-facing staff to obtain certain information. Your F&Is need to identify and verify and do the due diligence. And your cash reporting officer will report, and your money laundering control officer will be involved in suspicious transactions. So that's where the ball's going to be bounced. So just keep that in mind. We really need to know who's responsible for what. Of course, all your staff needs to be trained on these controls. And if there's a breach in any of these controls, we need to know what measures are going to be taken, who it needs to be escalated to, and what remedial action you will take in this regard. So all of that needs to be noted under the governance section of this specific policy. Now, the next part is your risk assessment and risk rating, and this should also be evidenced in your risk management and compliance program. And in this regard, you have to take a risk-based approach, and your risk-based approach needs to show what risks you as a business have identified within the entity as well as different business areas, how the risk of new products or services will be determined to ensure adequate risk rating, your client level risk assessment, which indicators you're going to consider. So when we talk about indicators, you're going to have a look at your client type, in other words, your target market. Do we deal with legal entities? Are they trusts? Are they PTY limiteds? Is it partnerships? Is it natural persons? What type of product do you offer? So have a look at the type of vehicle. You've got new vehicles, pre-owned vehicles. Have a look at your geographical location, your delivery channel, and those type of things. So that when we talk about indicators, that's what we mean. We have to have a look at the intervals at which the risk rating will be determined, as well as the assigned weighting. So in other words, if it is a influential person, it will have a higher rating than, for example, a natural person. So that is something that you need to keep in consideration. The outcome of the rating will need to be recorded, and then you need to have appropriate identification and verification processes, which also needs to include enhanced control. So if you do identification and verification, and this is a high-risk client, there needs to be a bounce the ball to somebody else. Who's that person, and what would the enhanced controls be to ensure that proper identification and verification can be done prior to you entering into a business relationship with a specific client. Then the monitoring, you have to monitor, mitigate, and manage these controls relevant to the different risks. And this section also needs to note decisions taken relating to the different levels of risk. Now, we've spoken about identification and verification, and that is really your customer due diligence. And your customer due diligence process needs to tell you when you are not allowed to transact with a client. So you're not allowed to transact with an anonymous client, or of course these fraudsters that walk around and give you false information and work under fictitious names. So that is a no-go, and you walk away from those. You also need to note the different types of prospective clients, whether you've got existing clients, if there's beneficial owners, third parties taking delivery of the vehicle on behalf of the client. Then you'll have additional due diligence requirements that has to be noted in respect of legal persons, trusts, or partnerships. You'll have enhanced due diligence on high-risk business relationships. And then if it's a low-risk client, you'll have simplified due diligence. So this entire due diligence process has to be written down to show exactly when additional due diligence, when enhanced due diligence, when simplified due diligence will be done, and the onboarding process in that regard, whether it needs approval or not, especially when it's a high-risk business relationship or a single transaction. Then, of course, there's rules with regards to targeted financial sanctions controls, and it relates that these two sections. You have to have a section on terrorist financing and then a section on proliferation financing. But I've put them together because the requirements are similar. So with regards to both these type of financings, you need to have a targeted financial sanctions process in place. And this process needs to include how you will scrutinize the client's information against the United Nations Security Council resolution list. If you are going to use a system or have supporting processes to fulfill this function, you need to make that note. So I know the ABSA guys use Floorfin, the Ceriti Insignia system has got Contactable that they have on offer, so that can be a system that you might use. So if there's additional processes, if you actually have to manually go and have a look at the United Nations Security Council resolution list, then that's your process. What needs to happen? Do they need to do a print screen and add that as part of your control? So note all of that down. And if your client or your potential client appear on that list, what on earth are you going to do, and how will you go about freezing the account or stopping that transaction? Okay, so all of this step by step needs to be noted down in your risk management and compliance program. Now let's move on to your prominent influential persons. You need to have controls in place for these guys as well, and those controls or processes must show how you will scrutinize a prospective client or a person acting on behalf of a client, in other words, a third party that's collecting the vehicle, as well as beneficial ownership information. to establish whether this person is a DPIP or a FPPO. Now remember, a DPIP is a domestic prominent influential person, and an FPPO is a foreign prominent public official, and it also includes their family members and close associates. Now, once you've identified that this individual is a DPIP or a FPPO, your risk management and compliance program need to show how you will obtain approval from senior management to continue with a deal with a FPPO. It also needs to show how you will obtain approval from senior management to continue with the deal with a DPIP who is considered to be a high risk. It also needs to show how you will determine the source of funds and source of wealth of any of these parties, and which data sources you will use to determine if a person is a FPPO or a DPIP. So remember, again, you're using Contactable, you're using Floorfin. There's so many of these systems out there. So if you have a system that can assist, make sure that you note that is the source that you're going to use and how you're going to use it. Now, lastly, we need to have a look at monitoring, reporting, and record keeping. Again, these should be 3 separate sections in your risk management and compliance program. And I'm quickly going to go through them because it's very, very basic requirements. You know all of this, but let's just refresh. Now, with regards to the monitoring, you need to monitor the account, the transactions, and the activities. Your risk management compliance program has to show whether the processes will be a manual or automated process. So how will you monitor all of this? Automatic or manual? You also need to show how more complex or larger transactions will be examined, and those findings must be kept. Remember, if the FIC comes and knocks on your door, you need to show them what you've done and the processes you've taken, how you've eliminated risk, why the client, a high-risk client, became a low-risk client, and as well as your due diligence. So all of that needs to be managed. We need to ensure that it's actually happening. Sorry, not managed, monitored. Now, reporting, in this regard, you need to note the end-to-end process for identification of reportable transactions. So this includes who will be responsible for reporting, as well as the timeframes relevant to the report submission. There also needs to be clear instructions relating to tipping off and non-disclosure of suspicious transactions to other persons. So in other words, what's going to be the consequences? If you tip a client off, or if you disclose this to anybody, then as an accountable institution, you will take the following steps, the consequences. Now, lastly, the record keeping requirements must be noted. It should include which documents you require. If it's going to be kept in a hard copy or a soft copy, if it's going to be kept by a third party, we need a little bit more detail. You guys all use platforms. You use Ceriti, Signio, Fusion, used to use DealerNet. So most of our clients actually keep that information on those specific platforms. So we need to know, Lekker, how's it going to be kept? Is it going to be safe from destruction? What's the process? So that needs to be noted. Now, ladies and gentlemen, I know this is overwhelming, but it has to be done. You've got our numbers. Give us a call. If you need help, we can talk about this. Thank you very much for your time, and have a great day if you can. Thanks, man.
Hi there, and welcome back. Part 2 of our webinars will be divided into 2 sections. The first being the updates or legislation on the horizon, or the expected changes coming in with coffee. And this will be followed up by a very, very brief overview of the conflict of interests. So let me hand you over through to Peter, and he will take you through the legislation on the horizon.
Thank you. Once again, I have to refer you to the Retail Distribution Review, or RDR as we call it, published by the regulator back in 2014, because those proposals can be considered the forerunner of the regulatory changes that I'll be discussing in this presentation. Those proposals turned the insurance intermediary sector right on its head. It listed close to 60 significant changes to our insurance practices and regulations. I'm not sure if it was panic or surprise, but suddenly we were seeing publications and articles suggesting that the intermediary market was doomed. As the dust settled, we all realized that this new proposed legislation could not be implemented immediately and would have to take place over a period of time, possibly many years. And since that date, there have been continuous regulatory updates, and despite literally hundreds of objections, most of those original proposals have actually been incorporated into our laws with little, if any, amendments. But there are still a few to be introduced, and the Financial Sector Conduct Authority, I'm going to call that FSCA, that's what everybody else refers it to in the industry. So during this presentation, I'll just say, when I mean the FSCA or the Financial Sector Conduct Authority, I'm just going to say FSCA. Okay, now they have now published their regulatory plan for the coming 3 years. It's clear that FSCA believes that there are still key risks inherent in the current distribution landscape, and that these key risks could potentially contribute to poor customer outcomes. So they intend to go ahead with all these additional legislative changes. Now, FSCA's 21 to 25 regulatory plan, which they published at the end of last year, was nothing more than a corporate brochure singing their own praises. But they've just launched another one. They've just published another one. It's a 3-year plan which actually details what they're going to do. So my intention today is to summarize those plans. I'm aiming this presentation solely at the motor industry, and I'm addressing only those regulations that will have an impact on that motor sector. I'm going to ignore all the new legislation that's going to apply to banks, insurance companies, and investment managers, although there's bound to be ripples felt by the motor sector as a consequence, but nothing direct. Okay, so let's start this. We'll start with the COFFIE Act, the Conduct of Financial Institutions Act. Okay, we call it COFFIE, which when this is passed, it's no doubt going to reshape the future conduct regulatory framework. Its intention is to consolidate all the current conduct laws which apply to all the differing sectors in the financial services industry. And they're going to put all this into one single overarching piece of conduct legislation. It's a phenomenal job. Before I go into this, I really must explain where we are at present, because many of our clients are still confused. We know all about FAYS, and we also know that this new COFFIE Act is going to replace FAYS. But we also have the insurance acts to cope with, particularly those dealerships with binder agreements, and even more so, those that own cell captives. So we have the Short-Term Insurance Act, the Long-Term Insurance Act, and we've got the New Insurance Act. Although that's not so new anymore. In the past, the two insurance acts, that's the Long-Term Insurance Act and Short-Term Insurance Act, they each consisted of prudential requirements and conduct requirements. Although many conduct rules were embedded in the acts themselves, most were provided in subordinate legislation, such as directives, guidance notes, board notices, and of course, we've recently seen the Policyholder Protection Rules. The new Insurance Act was designed with only the prudential requirements in mind, such as licensing, financial soundness, which is a big thing, and of course, the insurance business itself. And that new prudential authority spent a good few years transferring every insurer from the old Act to the new Act. This new Act repealed all the prudential requirements in the old Acts, but all the conduct sections remained. In other words, conduct is being regulated under the old Acts, whereas the prudential requirements are being governed in terms of the new Insurance Act. In effect, it means that all three acts will continue until further notice. The Coffee Act will incorporate a savings provision that will provide that anything done or prescribed under a section of an act amended by the Coffee Act will remain valid and enforceable until replaced by a conduct standard or conduct standards. The significant body of subordinate legislation currently sitting under the old acts will therefore continue to exist even after the Coffee Act is triggered. The Coffee Act itself will be very different to what we presently understand because it will introduce principles-based regulation. Currently, businesses can argue that if something is not prohibited, it can be done. In the future, this is not going to be possible because every action must conform with a specific business principle. And with principles-based regulation, it's going to be FSCA that will decide whether an activity or business process adopted by a dealership or its F&Is meets a particular outcome or business principle. Although there'll be guidance notes and conduct standards used more frequently to inform outcomes and principle-based requirements, there can be no doubt that our job as compliance officers is going to be much more complex than ever it was in the past. We're going to have to redesign our entire compliance programs. I've already mentioned that insurance companies had to undergo the transition from the old Act to the new Act. During that process, every insurer had to reapply for its license, justifying experience and technical skills in each of the categories of insurance that it wished to transact. This process was very slow, which is why it took so long to transfer all insurers from one to the other. Now, a similar process is going to take place for intermediaries, and that includes the dealers. The Coffee Act will introduce an activity-based licensing framework under which every FSP will now hold a conduct license. And that license will authorize an FSP to perform one or more specifically defined activities. Although similar in actual activity, the description of the services will be different. For example, in place of intermediary services, we're going to see the term distribution, which incorporates sales and execution of sales. The term advice is going to be replaced with financial advice, which means providing a recommendation, guidance, or proposal that leads to the purchase or alteration of a financial product or to the conclusion of a loan or cession. And just note those last words. It's going to include advice relating to the provision of loans. A financial product, by the way, will still include all insurance products. But in addition, it will include the provision of credit that's provided in terms of a credit agreement and regulated in terms of the National Credit Act. Another significant difference, although we've not yet worked out why, is the fact that warranties and guarantees have been removed from the definition of insurance products and placed in a category of its own. Exactly how FSCA and the National Credit Regulator is going to work together and who will monitor what is not yet known. But a much stricter regulation on how the F&I deals with clients from a loan perspective is clearly on the horizon. There is already a memorandum of understanding between the National Credit Regulator and FSCA, which states that there will be collaboration and cooperation between them. The clause in that MOU specifically states that in order to facilitate the implementation of the MOU, procedures are going to be documented in protocols. Needless to say, we've never been given sight of any protocols, but there can be no doubt that whatever they are, they'll certainly impact on the F&I. Another major change will be that the regulator is adamant that there will be two very different types of intermediary. There will be one type that sells only one insurer's policies, and there will be another type, and they'll be deemed as independent, who will have a range of different insurers' products on offer. FSCA has not yet decided on what each of these are going to be called, but they are determined that from the title of each, consumers will immediately understand which category of intermediary they're going to be dealing with. Moreover, it would appear from all the communications that FSCA would actually like to follow what the UK regulator has done, which is to only allow the independents to be what we now call FSPs. In the UK, all agents of insurers, in other words, those that only sell that insurer's products, are actually on the insurer's license. In effect, they're what we call juristic representatives at the moment. That would mean that any non-compliance by an agent would automatically be non-compliance by the insurer, saving the regulator an awful lot of supervisory time, which is obviously why they're considering that route. Whether this is going to be implemented or not remains to be seen, but we do know that it is a preference of FSCA, even if they haven't specifically mentioned it at this stage. And of course, this clearly links in with the new cell captive licensing requirement. It's still the intention of FSCA to prohibit a representative from acting on more than one license, unless there are good reasons for doing so, such as when there is more than one FSP in a dealership group. But as far as I can see, this is not going to have an impact on any of our clients at this stage anyway. Also, in the opinion of FSCA, the collection of premium by an intermediary is and is going to continue to be an undesirable industry practice. And of course, FSCA quote the failure of insure group managers as evidence of their opinion. They clearly believe that the current premium collection regulations are inconsistent with the delivery of fair outcomes to customers, and that it potentially creates stability risks for the insurance industry in general. As a consequence, FSCA has made a number of regulatory changes over the past couple of years, primarily culminating in the type of bank account that a collection agent has to set up and maintain. But in regard to the selling of term insurances, the motor industry has enjoyed an exemption and can still collect warranty premium, provided it forms part of the capital sum. The question is, how long will the motor industry enjoy that privilege? The current exemption is good for the next 18 months, but pressure is being placed on insurance companies that are providing that facility to ensure that they have the capital base to cater for a total loss of premium held by their intermediaries. This puts an incredible strain on their capital reserves. So there can be no doubt that some form of collateral is going to have to be lodged with the insurer if a dealership wishes to continue enjoying that facility. Exactly what that will amount to will be at the discretion of each insurer, but it's not going to be a small sum. For those enjoying cell captive arrangements, you can be sure that the capital base of each cell will be carefully scrutinized by the cell carrier. For a number of years, we've been telling our clients that there will be a complete split between income for providing advice and income for providing a sales and distribution service. But so far, FSCA hasn't been able to concentrate on this. In their regulation plan, they state that this and a few other issues will be addressed, but only when COFI is triggered and only when conduct standards are drafted and agreed upon. So it looks like we have a good few years ahead of us before we see this change come into effect. Inspection fees are handled in the motor sector in one of two ways. Some dealerships charge an inspection fee to the customer, whereas others charge it to the insurer. Inspection fees are payable by the insurer and cannot be charged to the customer, despite the fact that many dealerships still do this. This is addressed by Directive 97A2, which states that an insurer, as part of its risk analysis, is entitled to have a vehicle inspected for mechanical faults, with the inspection fee only payable by the insurer on receipt of an inspection report. The level of inspection fee is to depend on the type and style of inspection, but either way, it must be commensurate to the service provided. This means that perhaps it should be based on an hour or labour or specialist time rather than a percentage of actual premium. Now, you'll be pleased to know that inspection fees as a specific activity is not under the FSCA spotlight per se, but they do fall within FSCA's outsourcing conduct standards. Outsourcing is defined as a service or activity which would normally be performed by the insurer. Risk surveys are carried out internally by insurers as part of their risk analysis, but where the risk is complex or large, these are outsourced to specialists, and mechanical inspections of vehicles clearly require specialist knowledge. So in terms of the conduct standards for outsourced functions, there are two categories, being those that are material and those that are not. Material functions that are outsourced have to be reported to FSCA, excuse me, but others only have to conform with the standards laid down, which includes how fees or inspection fees, or in this case survey fees, whatever they might be, are determined. So compliance with those standards is now being carefully monitored by FSCA. So insurers are beginning to look at the fees charged for the services they outsource. If not already discussed with you, you can expect your insurers to be in touch with you about inspection processes in the not too distant future. Way back in 2018, we were warned that in order to monitor whether the financial system is delivering fair outcomes to customers, FSCA would need access to what they called meaningful, reliable, measurable and comparable information on key conduct indicators. Now, quite a mouthful, but their first step was to inform us that the annual compliance reports were to be discontinued and replaced with a business conduct return. Indeed, the last compliance report submitted to FSCA was in that year, 2018. Although a number of draft business conduct returns were published for comment, it was only at the end of last year that we were all informed that a detailed business return platform would be developed for completion during 2022. In readiness for the implementation of COFI and all the new legislation, FSCA had to ensure that the information they had on record about every dealership, its KIs and F&Is, was accurate. So to achieve this, they recently asked every FSP to go through all the details that the FSCA had on record and correct those records as appropriate. Having ensured that the information they have about the FSP is correct, they moved on to the next and the more complicated task of ascertaining details of the type of information that they will be looking for in the future. There's no need for me to list the information that they have asked for. Suffice it for me to say that if you have not already done so, please start working with your administrators to ensure that you both have sufficient information about your customers to satisfy the needs of FSCA. I've already mentioned that under the new insurance laws, conduct standards will be published by the regulators to set out what is required in terms of certain business principles. These will be, and already are, being published by the Prudential Authority and the Conduct Authority, depending on which authority is responsible for that particular oversight. Sometimes they are going to be joint standards, where the standards are required by both authorities. On the 1st of June 2020, the very first joint standard was published, and this outlined the roles and responsibilities of significant owners. This included specific reporting obligations of significant owners, the criteria that must be met by significant owners in order to be considered fit and proper, as well as prescribing what constitutes the ability of a person to control or influence the business or strategy of a company. You didn't hear too much about that from us, simply because all FSPs were exempted unless they were also an insurer, but sadly not for much longer. I want to show you something. The FSCA recently published a communication, and I'll read this. I don't normally read slides, but I'll read this. The main aim of the joint standard is to ensure that significant owners are honest and have the necessary integrity. In FSCA's opinion, honesty and integrity is a fundamental characteristic that should be displayed by significant owners of all financial institutions. In addition, FSCA is of the view that the requirement to be honest and have integrity will not create an undue burden on significant owners of FSPs, including significant owners of small FSPs. From this, it's pretty clear to us that this will be introduced to our laws very soon. We would not be surprised if it was to take place this side of Christmas 2022. So what would it mean if FSPs did have to comply with that joint standard? Well, FSPs will have to have procedures in place, but these procedures wouldn't be too onerous. In all probability, they'll be similar to what KIs have to do now, which includes completing a comprehensive fit and proper questionnaire. But unless the significant owners are also directors, none have had to complete those types of questionnaires in the past, and we anticipate that this is going to cause a problem or two. So we have to say, what is a significant owner? FSCA allocates an entire section to significant ownership. So if you think this could affect you, I think it would be wise if you took a look at that section in the Financial Sector Regulation Act. In a nutshell, it states that a significant owner is a natural person that can control 15% of a company's management. Finally, moving on, and just as a matter of interest, we shall see the 800,000 limit imposed on the phase-on bud increased to around 3.5 million by the end of the year. This might mean that you should consider increasing your PI limit if you've chosen a lesser amount. At present, the minimum required limit in terms of regulation is 1 million rand, and so far there's been no indication that this will change. but it might just be in your interest to revisit your own coverage in the meantime. That's obviously it for now. I hope I haven't sent you to sleep. And with that, I'll hand you back to the team. Go well.
Hi there. If you have any queries or questions, please could you direct them through to Peter. His email address and the telephone number will be up on the screen at the end of this particular presentation. We're now going to touch base on a very brief video on the changes to conflict of interest.
Thank you for that introduction. 8 years ago, the regulator published a document outlining all their proposed regulatory changes for the future. That paper was called the Retail Distribution Review. We know it as the RDR. Although those proposals were discussed frequently and in fact argued by all interested parties, they have just about all been incorporated into our laws with little, if any, amendment. But there are still some to go, and the regulator has now published its regulatory plan for the coming 3 years, in which they've mentioned that the ones that are going to be incorporated in the very near future, and some they've just made inferences to, but we are pretty convinced that they will occur. We just don't know when. Now, over those past 8 years, all the primary legislative changes have related to what the regulator believed were the key risks inherent in the current distribution landscape, including distribution relationships and intermediary commissions, and models that could potentially contribute to poor customer outcomes. One of their leading concerns has always been, and will continue to be, conflicts of interest that exist in the distribution chain. In my next presentation, I'll be summarizing all the regulations on the horizon that's going to impact on the motor sector. But as the Coffee Act, or the Conduct of Financial Institutions Act, we know it's Coffee, but as the Coffee Act will be the final piece of the puzzle, allowing the regulator to use principles rather than rules to sanction offenders, I believe it's important to revisit the conflicts of interest that the F&I has to face daily, and perhaps look at how those conflicts can be avoided. So first we have to say, what is a conflict of interest? In general terms, a conflict exists where an employee is facing an issue that may influence the objective performance of his or her obligations to his or her employer or customer. In very simple terms, I'd define it as any situation in the workplace where an employee has interests and loyalties that are actually at odds with one another, and where a customer or the employer could end up with a biased or unfair service. Conflicting interests arise all the time, and it's impossible to draw up an exhaustive list. But most businesses or companies have introduced a conflict of interest management policy that addresses typical conflicts that frequently arise in that particular business. These policies usually address issues like owning shares in companies, holding office, serving on another's board, and similar things. Some conflicts of interest policies even address the way an employee can use the company's time and equipment. It's not my intention to cover all of these in this presentation. I merely want to talk about the conflicts of interest that may arise between a representative and a financial customer. In other words, the F&I and the buyer of the vehicle. I'll be looking at the rules laid down in our insurance laws, as well as how the regulator wants every FSP, which includes dealerships, and how they handle and deal with conflicts. F&Is as we know, they're considered by the regulator as expert practitioners who are operating in a specific sector of the financial services industry and who provide the general public with professional advice. Therefore, their actions must be transparent and open to scrutiny by customers, potential customers, and now, in view of the power of social media, by members of the general public. Consequently, they have the responsibility of administering the dealership's affairs honestly and prudently, and of exercising their best care, skill, and judgment for the sole benefit of the customers. In other words, they must exercise utmost good faith in everything they do, with the interests of customers being their first priority when making any recommendation. So, for these reasons, conflicts of interests that could affect financial customers has always been very high on the regulator's list of concerns, but it has gained even further heights based on their 3-year regulatory plan. And financial services is not confined to insurance policies. You may or may not be aware that the regulator is considering all aspects of the F&I's functions, and particularly in respect of the advice and disclosures they make on behalf of the banks when dealing with loan applications. So for this presentation, I'm going to be looking at 3 specific areas of conflict that frequently arise in the motor sector. I'll deal with each one of these separately, but first I think it's important to mention that the existence of a conflict of interest is not necessarily evidence of any wrongdoing. And in many instances, it's virtually impossible to avoid conflicts of interest. Conflict of interest can only really be of concern when an individual tries and possibly succeeds in influencing the outcome of a decision for either personal benefit and or for the benefit of the dealership. So let's first look at financial interest. Financial interest is actually defined in our insurance laws and includes just about everything you can think of that relates to money. The definition doesn't just refer to cash and cash equivalents, but specifically mentions things like vouchers, gifts, services, advantages, benefits, and discounts. It even includes domestic or foreign travel, hospitality, accommodation, sponsorship, etc. And it ends up mentioning other incentives and valuable consideration. So those final words in that definition close any gaps that an imaginative person might be able to dream up. So let's look at this in context in regard to the F&I in the dealership. If an F&I is offered some form of gift from an insurer or other supplier of goods, which forms part of the F&I's products that the F&I has on sale to customers, this could be very uncomfortable for the F&I. If the gift is accepted, it might not influence the F&I at all, but there can be no doubt at all that others will perceive things differently. And if the gift is refused, there's a possibility that it might be seen as an insult, a very difficult position indeed for the F&I. So what form of gift will this entail? Bearing in mind the definition of financial interest, it could mean a whole host of things. It will certainly include actual gifts for a special occasion, such as a birthday or Christmas, but it will also include more kind of indistinguishable gifts, such as entering into prizes and competitions, which are awarded by insurers and banks for targets achieved. Golf days and other social events are still common. So are booze cruises and similar functions which frequently occur, definitely toward the end of the year. So even though these are clearly incentives that are provided purely as offerings by suppliers to encourage support from F&Is and the dealerships, Nevertheless, they're extremely difficult to decline. The best way to going about this is for the KI to approach its suppliers and let them know that this is not an acceptable practice, and in fact is contrary to the governance of the dealership. The regulator has actually taken this into account and has addressed it by prohibiting an insurer or any other FSP or representative to offer any such gift. In fact, if some form of incentive which falls under the definition of financial interest is offered, both the company that offered it and the recipient can face a severe penalty. In the motor sector, the incentives that an insurer or other FSP can offer are extremely limited. At the moment, the maximum commission allowable is 12.5% of gross premium for motor risks and 20% for all others. Credit life commissions are considerably lower, but as this commission is ongoing, insurance companies often find ways of some form of upfront payment. How they do that is not for discussion today. There are some other limitations, but these apply to accident and health type risks, which most dealerships don't sell. And just as a matter of interest, warranties, like the type that F&Is sell, are no longer classified as motor risks. Indeed, they're specifically excluded from the definition of motor risks in the Insurance Act. Fees charged directly to a client where no commission is paid is fairly common in the corporate broking market, but I haven't seen it in the third-party retail motor sector. This is where the commission is discounted directly to the customer and where the broker negotiates a fee for ongoing advice and administration services. And these services are then listed in some kind of service level agreement. Finally, there are fees or remuneration for the rendering of a service to a third party. This relates to any extra work that a dealership might do for another person. For example, corporate brokers might also undertake fire and crime surveys on behalf of insurers. Motor dealerships often carry out inspections of vehicles prior to an insurer issuing a warranty policy, etc. But in each of these cases, the fees charged must be reasonably commensurate with the service being rendered. Naturally, that fee must take into account the nature of the service and the resources, skills, and competencies reasonably required to perform that service. For example, an attorney or accountant is likely to charge more than a salesman who's only following an occupation. Also, those fees charged must not result in the dealership being remunerated more than once for performing a similar service. For example, a dealership won't be able to charge for professional advice when selling an insurance policy because the rate of commission presently includes that service. There is a minor exemption in respect of financial interest. When the regulator imposed these rules, one of the many arguments against the imposition of these conditions was that it would exclude allowing one FSP to give another FSP even a cup of tea when being visited. So the regulator kind of capitulated and allowed an amount of up to 1,000 Rand per year per FSP to cater for those occasions. This they call an immaterial financial interest. One area that has not been overlooked by the regulator is the manner by which motor dealers incentivize its F&Is. The motor industry has traditionally paid its F&Is with a small monthly salary boosted by commission for concluding finance and insurance contracts. The regulator believes that remuneration structures based on sales successes can lead to unintended behavioral consequences. But at the same time, they realize that the motor industry has worked this way for years and will probably continue to do so. So As a consequence, they demand that dealerships introduce specific controls which ensure that quantity of business secured is not at the expense of the quality of the service rendered to its customers. How a dealership does this is entirely up to its management, but from our part as compliance officers, we try to include in our random monitoring of F&Is that the advice and disclosures provided to customers actually correlates with the concept of treating customers fairly, or TCF as we know it. But that's not always possible, as we only really see the end result. The regulator requires a dealership to actually put controls in place to mitigate this concern. And these controls must be clearly evidenced in the dealership's governance policies. In fact, they are quite specific in that a dealership must be able to demonstrate that it develops and adopts measurable indicators that address these three aspects that I've got on the screen here: the minimum service level standards, the delivery of fair outcomes for clients, and the quality of the F&I's compliance program. Now, we partly address this in our monitoring reviews by scoring each F&I, but it is still the responsibility of the dealership's management to incorporate it in the company's overall governance structure. Some dealerships still provide additional incentives to an F&I for giving preference to a specific policy where the F&I has more than one type of policy on offer. This mainly occurs in respect of OEM products, where the dealership gets preferential margins on parts or other incentives when certain warranty sales targets, when their targets are actually met. Now, the regulator deals with this in the FASE General Code of Conduct by prohibiting a dealership from incentivizing its F&Is for giving preference to a specific product supplier, or for giving preference to a specific product of a product supplier. Finally, in dealing with a financial interest, the thought that perhaps this whole issue of conflicts can be avoided if an associate company, not being an FSP, could provide the incentives, thus circumventing all these rules. This has also been addressed in the code, and there's a specific clause which actually states a provider or representative may not avoid, limit, or circumvent, or attempt to avoid, limit, or circumvent compliance with this section through an associate or an arrangement involving an associate. So they've shut the door on that one. Let's now look at ownership interests, which is so much clearer. An ownership interest simply refers to dividends, profit share, or similar benefit derived from an equity or ownership. The FASE General Code of Conduct demands that a dealership and or its F&Is must avoid, and where this is not possible, mitigate any conflict of interest that exists. And if it cannot be avoided, it must disclose to the customer the extent of that conflict. In the motor sector, most conflicts arise through sell captive ownership and outsourced agreements, although there are others. For example, it's compulsory for the F&I to disclose whether the dealership holds more than 10% of the insurer's shares, or whether the insurer pays the dealership more than 30% of all the remuneration it receives. But today, I'm just going to deal with the most common, being sell captive ownership and binder fees. A sell captive is really nothing more than a type of shareholding, but it is best described and understood as a mini insurance company owned by a dealership. All insurance companies are so strictly regulated, particularly in regard to their capital base and structure, that very few fail, and most, if not all, make substantial profits. In the eyes of the regulator, the profit that a sell captive can achieve far exceeds commission. So it would naturally be in the interests of a dealership to give preference to an insurer which it owns, rather than placing the business with an insurer that only provides a commission. Naturally, the regulator sees this as a very real conflict, which often results in unfair practice. A substantial revision of cell captive ownership, as you well know, is presently being undertaken by the regulator. But in the meantime, it is expected of cell owners to explain to every customer why the use of a cell captive is not in conflict with the customer's rights, and that placing the customer's insurances in the cell captive will not result in unfair treatment to that customer. Now let's look at outsourced agreements, but particularly binders. When an intermediary carries out administration work on behalf of an insurer, which an insurer is normally expected to do for itself, that insurer is allowed to pay a fee over and above commission. In the motor sector, it is common practice for the F&I to bind an insurer at the point of sale and issue a policy on behalf of the insurer. This onboarding saves the insurer considerable time, but this additional fee could encourage the dealership to give preference to the issue of policies that might not be in the best interests of the customer. The dealership is expected to disclose this extra fee and explain why there is no conflict of interest involved. Finally, let's look at relationships with third parties that could result in conflicts. First, we have to look at what we mean by third parties. These are defined in our insurance laws and consist of 5 types. I'm not going to spend much time on this, as conflicts arising from these relationships tend to be covered by what I've already mentioned. What I would like to do is to just clear up some confusion that often arises. A product supplier is an insurer, and in the context of this presentation relates to an insurer that does business with the dealership or would like to do business with a dealership. On the other hand, a product provider rather than supplier is usually an intermediary. Where an insurer sells directly to the consumer, that company would be both a supplier and a provider. In the context of this presentation, it would particularly refer to an OEM financial services provider, which operates as an intermediary, which usually, but not always, owns a cell captive. Sometimes an OEM also demands a share in the commission or demands that the dealership factors all commissions after a certain time period. Earlier, I mentioned that to eliminate the possibility of an associate of a supplier or provider from offering a financial interest to a dealership, a prohibition to this effect was included in the FAY's General Code of Conduct. The General Code of Conduct provides a full definition of the term associate, and it is so wide there can be no misinterpretations here. To give you an idea, when defining a natural person, they even include relationships recognized in religions as the spouse, life partner, or civil union partner of that person, as well as those in a commercial partnership with that person. It's very, very broad. So associates include just about everybody. A distribution channel is also very broadly defined and includes not only all the persons involved in the distribution and administration process, but it includes their associates and any arrangement involving their associates. This would include the administrators and underwriting managers that have been tasked with providing services such as claims handling and the like. And finally, there is this simple wraparound clause which combines any relationship arising from any of the third parties that I've just been speaking about. That's it for now. It was never my intention to cover conflicts of interest outside those that arise between a dealership and a customer. So what I've said today can't be considered finite in any respect, but it will provide the gist of what is required in terms of our insurance laws. We'll chat again soon, no doubt. In the meantime, go well.
This brings us to the end of our November webinar. The contact details for Jeanette and Peter are on your screen right now. If you have not yet received any of your CPD certificates from the September or October webinars, please, if you could get in touch with Johan. All of our webinars will be or are available on our website, details underneath, which is www.acmotor.co.za/webinars. Our next webinar series will be next year, and that will be conducted in February, unless, of course, there are any immediate changes that we need to keep you up to date with. So with that, goodbye, and we will see you in the new year.